Welcome to the Drill Down, in-depth answers to oilfield questions. I'm John Spears.
And I'm Richard Spears.
So, Rich, I think, we always say in-depth answers to oilfield questions. I think the subtitle could also be Learning from Our Mistakes.
Well, that would be a very, very, very long show.
Well, maybe or maybe not. I mean, you think about all those examples where people haven't learned from their mistakes, right? Like invading Russia in the summertime, bad idea.
Invading Russia in the wintertime, bad idea.
Marrying Henry VIII. That's a bad idea.
Oh,
Everybody
they did that eight
Yeah.
different times.
Right. Making Caddyshack 2, for example, with a Rotten Tomato score of 4%. So
is that like the worst one ever that was like a big one?
No, I think Weekend at Bernie's Part 2 has a perfect 0 score.
But again, like last show,
Yeah.
Godfather, the second one, better than the first one. So you just can't know for sure.
But there's still that example out there about, learning as you go and improving, right? And so I want to talk a little bit about or ask the question, are oil prices still important if you're trying to forecast activity in the oil patch? And I might lead off that discussion by saying you've had an interesting example recently.
Yeah. So if any listener to this show has at least tangential interest in the oilfield service sector, and most oilfield service companies are not having their best months or their best quarters that from the last, say, 5 years or 10 years. But I sit on lots of boards, and yesterday I was at one of those companies looking at some things in the factory, and the chief financial officer pointed out that we had just finished our third month in a row, which was a record. And this is a company that is, it's over 50 years old, so it's been through the thick and thin. It's been through $150 oil, it's been through negative dollar oil, and it was active in 2014, it was active in 2018, but in the summer of 2022, it's having the best months, and therefore it's going to be the best quarter it ever had. And so
and that's happening at the same time when oil prices have fallen for the past
the entire
3
time.
months.
Yeah. They were 140, then 120, then 100, and today they're 80 something.
So those kind of short-term events do happen. But I think it's it's something we should pay attention to, perhaps, because in the past, whenever we've wanted to think about where is activity going, the first thing we look to is where are oil prices going to set, right? And the notion being that oil prices rising or falling send a signal to both consumers and to producers as to how their behavior should change, right? I mean, that's the classic.
Tell me what you think oil price is going to be,
right?
And I'll tell you what activity.
Absolutely.
It's going to influence activity.
Absolutely.
Same with natural gas prices.
Yeah, right. And we think of it most of the time for operators and service companies, but it serves for consumers alike. And oil prices are going up, then people should be conserving more, right?
Yep.
And then on the same side of oil prices going up, producers should be supplying more, right? So, but when you think about just consumers for a second, oil prices rise and or recession sets in, and what you tend to see is a very minimal change in consumption, right? The typical economic recession in the U.S. results in something like a 2% decrease in oil use here in the U.S. So
they're still heating the home. They're still got Netflix on. They still are driving to their kids' baseball game.
Yeah, right. They may not take that long driving trip, but at the end of the day, that's not a huge part of the.
So it's just a 2% hit.
That's typically what it is.
Demand for hydrocarbons.
Yeah, here in the U.S. has been. Yeah. So yes, higher prices send a signal to conserve, but it doesn't affect consumer behavior very much. So that's kind of an interesting thing when you say, well, how important are oil prices in changing behavior, right? And on the consumer side, you say the importance isn't very great, right?
So I think you're teeing us up to say that oil prices may not be as important as they were on the producer side.
So you think about, on the supply guy side, and again, we should probably say this is a discussion mostly around North American operator behavior, because internationally, we've always known that because of the tougher logistics, because of the high government tax takes, right?
Yes, the tax or the take by the government has a greater influence on drilling activity in most countries,
right,
than the price of oil does.
Yeah. So, for example, it's I guess a reasonable rule of thumb that the host government takes about 60% of the price of oil in one form or another for the from the oil company to work in the country. So that's
it is their oil.
It is their oil in their country and the whole 9 yards. So you got to play by their rules, and so changing that tax take can often mean a lot more to the bottom line of an oil company than whether the price of oil goes up or down a few bucks, right? So internationally, the rules are a little bit different. But just thinking about North America, in the past anyway, we thought, well, boy, oil prices go up. That's a strong signal, and we would expect operators to respond with more rigs and more wells, and that has typically been the case.
And
right?
so if the price of oil went up 20%, would drilling activity go up?
You'd begin to see within 3 to 6 months almost a proportional response.
So a 20% increase in drilling activity, 90, 100 days later.
Something like, yes, it would begin to happen, and then it would take a few months to roll into fully be felt.
And if oil prices fell, same thing with drilling activity, it would fall.
Very good. But now I'm thinking that, we hear more and more about operators saying, listen, we're going to, so long as oil prices are above a certain level, right?
We're going certain level.
Yes, and so we're not optimizing our spending based on oil prices. We're sort of looking for a satisfactory oil price, and we're going to set spending, and that's what we're going to stick to.
A sufficient amount of oil price, if you will.
Yeah, right. So again, it's not so much that oil prices are 110 or 97 or even 85, right? It's they're above a certain level that the operator can make money at. And so he is looking to grow his production a certain amount, and so the production growth figure becomes much more important to his activity level than just the per barrel price of oil, I think.
All right, so I'm going to be the person who's riding on the train in from Connecticut into New York City, or driving in car from Katy into downtown Houston.
Yep.
And right now I'm beginning to think, all right, so what do I think is that sufficient oil price level? And I already know $50 is not going to do it.
Not in this cost environment, right?
No, because costs are pretty significant.
Yeah.
And so I'm going to go, well, it's probably not 60 either. But I also know that it's not 100.
Yeah.
So what do you think that is?
A year ago, at the end of 2021, the Dallas Fed did a survey, and they asked operators, what is the break-even price to in various basins that you need to see in order to break even on operating on your operations? And in most areas, it was, in round numbers, around $55 a barrel. Right. That was the end of last year. Since then, broadly speaking, costs have gone up 20%. So that would add another $10 to $15 to that.
So I get to 55 now, maybe at 70.
You might be to 70, right? And then thinking about the next year, inflation could go up a little bit more. So I think a 70 to 80 range is probably the minimum, the sufficient number, right? And above, so you get to pricing in that range, then you're, as an operator, making money. And you certainly begin to see publicly traded guys, right? That allows them to self-fund their CapEx, and it provides them a certain amount of money to retire debt or do stock buybacks, those kind of things, right?
Well, it's been your position, and more people who are analysts in the industry who say that the reduction of debt on the E&P side of the business is going to be about done in the not too distant future.
We may live to see the day.
That's right. That's right.
Yeah, that's an interesting phenomenon, isn't it? So now that would free up some capital that's going toward debt reduction, and you say, now what do you do with it, right? And I think it goes to stockholders, right, as opposed to service companies. Yeah.
And by that you mean I'm an owner of the oil company. I get the money. Yeah. Because the oil company didn't drill another well and pay Halliburton to go, provide the drilling fluid on.
Yeah, that's exactly right. So I think again, our oil price is still important. I think there's certainly a class of operator, the publicly traded companies, whose behavior has fundamentally shifted away from paying attention to that marginal dollar as directing their programs, and really looking at a sort of a base level of activity, funded with oil prices at a sufficient level, right?
So is that, if we have round numbers, 800 drilling rigs employed, is that 400 of them? Is it 500 of them?
Yes.
Is it 600 of them?
The publicly traded guys have typically, accounted for 50 to 60% of the oil and 40 to 50% of the rigs. So there's a substantial number of active rigs today that are in the hands of what we think of as private firms, right?
And they'll be way more responsive. They may still be responsive to the price of oil.
They might be, although it's there's a lot of them who are family companies that have been in business for 100 years, and I think have typically been very conservative from a financial standpoint, conservatively managed. Otherwise, they would not have been in business for 100 years,
That's
right? So you can't just paint a broad brush and say that all the privates are still going to behave like drunken sailors.
So if you're an oil company that has the words oil and ranch after whatever your last name is, you're probably...
I think that's right, but clearly a substantial portion of the oil company group it has changed its behavior, and I really think that we as analysts now probably should back away from this singular focus on oil and gas prices and think more broadly about really what's driving activity and where can we pick up signals about how those estimates are changing. So,
one of the things that our customers can do at home in their free time is they can just go on Excel and they can plot data series alongside each other. They can plot every day's price of oil and every day's rig count, and then just create an XY scatter graph.
Oh yeah.
And see if those two numbers, those two data series, create a straight line, or if it looks like a shotgun has a guy's been driving down the road and fired at the stop sign with his
Yeah, no, I got you right. Yeah, is there a pattern in that data? Yeah, so
because you're saying that there would be less and less of a pattern anymore.
I believe that's right. Yes, right. So this will lead us to yet another podcast down the road about the science of paired oscillators. So this is what you're talking about.
And two brothers talking. That's like paired oscillators.
By the way, the folks who are watching this podcast on YouTube would look at us and say that we are the before and after versions of Casual Friday, I think, right? So I want to keep that in mind.
Well, I'm wearing a white shirt and I actually have a tie. I've loosened it and you're not.
I've sold mine, yeah.
You are actually wearing a shirt.
Yeah.
Probably they would want to know that if they want to communicate with us and somehow can't find us, they can use drilldownshow@gmail.com. They can also follow us on pretty much everything.
That's right.
You got your Twitter. You've got your LinkedIn. You can go to the website, spearsresearch.com. And maybe, do we have Instagram? We don't have Instagram.
By golly, we're going to get one. Yeah.
But we'll be tweeting all day long.
Sounds good. Anyway, thanks so much for spending your time with us today. I'm John Spears.
And I'm Richard Spears.